Right, so maybe we'll just start with a quick overview on what it is you do and a bit about the organisation you come from.
G'day, my name's Abadeen. I run the development business for Abadeen out of New South Wales. Been in property pretty much all my life. Started facilities management, then moved into property development, project management, consultancy, construction in various different fields. Worked across most industries now. Joined Abadeen about 7 years ago to head up the development business and sort of grown it to where we are today with Justin Brown at the head there in Sydney and opened Melbourne last year under Andrew the Intellis.
Thanks, Matt. So, Corey Nugent, I'm the CEO of Resilience Insurance. So, we're the first and original provider of latent movements insurance to Australia, which is a new product that originated overseas, operated for over 70 years, but we brought it here to Australia and been battling away to educate markets on why it's the best new thing. So, and no, I'm not an insurance salesperson, but I'll tell you it's the best new thing.
Simon Hulett, so I head up the equity business at MaxCap Group. So MaxCap is a large commercial real estate investment house. We are a big unpack lender. We have about $7 billion under management across the credit and equity space. On the equity side, we invest through joint venture partnerships, primarily into development. So I've been working in the development game for about 20 years. And we've got around 26 active partnerships around the country at the moment across all different sectors, so we get a good exposure to what's going on around different markets.
And so I'm going to ask you first then, so talk to us a bit about, you guys are across a lot of projects. What do you do? How do you assess risk and how's that changing this year?
Because we are a sector agnostic, geographically agnostic investor, I think we have to try and be really consistent in our approach to underwriting risk. In the development world, we are really focused into, I guess, three key elements: partner, product, location. Not necessarily in that order, but because we're investing into joint venture partnerships, the most important decision that we make is who we're investing with and into. And for us, I think that what's become really evident over the last 12 to 18 months is that we really want to invest with groups that are essentially sticking to their knitting, be it geography, be it sector, that established track record, knowing their market. That's really important for us. And then we overlay the elements of location and the product itself across that. But I think that when we're looking at managing our risk and the experiences that we've had, and we've had some challenging experiences, we've had some wonderful experiences, but I think backing in our existing partners, and when we're looking at choosing new partners, it's making sure that there's that established track record there.
Same for you, Corey.
There's some really points that are made there. One of the elements is our confidence. So one of the things that we would say is we would look at who the partner is, who's building, who's developing, who's producing that product. And again, we're agnostic in terms of location, but it's about that partner and who we're working through. So we are not an insurance entity that will say yes to everyone. We've in fact said no to many because they're just not the right partner. One of the things that we take really critical is building confidence. So I think one of the things that Scott was talking about earlier in the conversation was changing that game and confidence, and how do we bring people back to that market and work that through. It's one of the elements of what we do is establishing that position of confidence in and building that confidence in the builder and the developer for the consumer market. I think partnership with you, Mike, for example, with that, the partnership with you, for example, is something that we've seen phenomenal growth in from a consumer end in terms of the communication we've been able to have to that side of the market and see where that's going. We've got some quasi tier 1, tier 2 builder developers in New South Wales and Victoria that are now seeing and reporting that they can't avoid latent defects insurance anymore because consumers in their display suites are in significant numbers turning up and asking the question, do you have it? And people are selecting against properties without it. It is adding the value. So, and that's part and parcel of really strong benefit of what we've been able to do with you, Mike, and George and the team at Urban to be able to build that through.
Appreciate it.
Yeah, I think I'd probably say the same thing in terms of it's all about the partnerships of the development, whether it be the site and location to start with, and that you can get sales, and then as it comes through who your partners are, who your consultants are, who the project team is, which builder you pick, who your financial backers are, who the bank are, and to touch on your point, Corey, around the land and defect insurance, that sort of come into play through the strata bond and defects issues that New South Wales has faced, and it has been picking up steam, and we've sort of Abadeen in New South Wales have taken that on board. So some of the purchases it doesn't factor in too much, definitely at the top end of the market and the more expensive apartments, but through the general market, yes, it's now becoming important to we build the product, we finish the product, and someone will be there to fix it if something goes wrong afterwards.
That's a really good point in terms of that strata bond. So it has been a pretty good point in New South Wales, and there is different segments of the market that some will say, from the consumer point, that it's important to them, and others that won't. It won't play a factor in terms of some of those markets. But from a Victorian perspective, what we know is that there's legislation in Parliament now that the strata bond, like New South Wales, is coming. It will be here before the end of the year. There will be a strata bond in New South Wales, and it will apply to all those developments. So it's something where if you're in planning, if you're in DA or getting to that point working through FISO, you need to be asking that question now in terms of your cost base and confidence base. What does that look like, and how does that move forward?
So, I mean, for all three of you guys, you're kind of in the risk management business in different kinds of ways. Obviously, it's hard to fix a problem the further it kind of goes along. So how do you kind of think about addressing some of the risk at the earlier stages of the project? You mentioned about people sticking to the knitting, but what other things are you kind of looking for in those early stages?
Yeah, it's interesting on the sticking to the knitting point, the slide you brought up earlier that had the milieu guys doing a project here in Brunswick, and Jeff and the Golden Age team out in Glen Waverley, like that's sticking to their knitting, right? That's going back to what they know and where they started for a large part. So I think that is really being emphasised at the moment. In terms of the early stage risk mitigation and management, I guess there's a couple of different ways that we look at that. One way is through the actual project related side. So how are we mitigating risk around the pre-construction elements of planning and whatnot. But I think sales for us, when we're talking about residential, build to sell res, the sales is a critical one. Like, where are those sales generally going to come from? Because one thing that is challenging, particularly in the equity side, is when you get to the end of the project, if you've still got unsold stock, and then residual stock finance is great, and it's a new product that's very prevalent in the market now, very popular with lenders, but it's expensive and it chews through profit fairly quickly. So the sales piece is a critical component. And then because of the way we participate in deals as a joint venture partner, as a capital partner, there's ways that we can mitigate our downside risk through how we structure our participation into a deal as well. So the timing of that, our positioning in the capital stack, and how that works with our partner as well. So there's two different elements in terms of how we look at that risk mitigation up front.
I know I prepared you for this one, but in terms of just the relationship as far as it goes to the builder, obviously that is one of the kind of key execution risk areas for any development, is kind of nailing the build process. How do you see the kind of partnering based approach as far as working with the builder and sharing some of the risk, and then how do you incorporate that into your own risk model?
Yeah, so I mean we like working with the builder developers. We like that model. It's a bit of a double-edged sword, and it can come with challenges as much as it comes with positives, but clearly through that initial phase it can give you a greater level of confidence around the build price and how that's going to be managed. I think at the same time, particularly when I think about our business has a lot of exposure into the market, a lot of IP, a lot of understanding around what's happening in markets, which builders are performing, which builders aren't, where is pricing going, what's pricing doing at any given point in time. So I think our business does that quite well in terms of gathering a lot of that IP and using that IP to help drive our underwriting at the same time. Because it's very hard for us to mitigate that risk in its totality. And we don't expect to be able to, but I think to the extent that we can leverage our advantage in the market, which is our sort of exposure across, both on the credit side and the equity side, that is a significant advantage for us.
mean, like, in terms of like MaxCap and our relationship, certainly you guys were the first people that ever approached us and said, hey, what data are you guys seeing? With Wayne and Bill approached us and be like, hey, you guys must have a lot of data. Can you come and show us what you've got and then see if we can kind of work something out? So it's like no one else really hit us up with that stuff for a long time and it was first with thing, and then it was like, well, maybe we can do an event together, and that's kind of how the whole partnership started. So I've seen it firsthand in terms of how you guys think about using your scale to kind of access new types of data to help you assess risk, and that's you guys are the only ones that, or certainly the first that ever approached us with that kind of thing.
So I think that we take that approach across how we underwrite all of those key assumptions, right? Whether it's revenue, whether it's, you know, I mean, you think about time, cost, and revenue, which are three key inputs that you need to evaluate there. Particularly on the cost side and the revenue side, that's where data is so important. And so we're always looking for any avenue we can find to gather as much data as we can.
Cool. Obviously, being an insurance business, you guys have got a lot of exposure to when things go wrong, it's not great. So how do you kind of think about establishing and assessing risk at the early stage?
That's the whole game of insurance is risk. That's exactly what we do. So, and from that point of view, our entire remit is to assess risk and pricing. That's what insurers do. From our point of view, one of the things we do with latent defects, it's a new product to Australia, and one of the advantages of it comes from Europe, and they've been doing this for decades. As I said, what we do is we take a much more proactive approach. So we've got to look at all of those elements and all of those providers that have a stakeholder. So whether it's Simon looking at finance risk and all of those elements he's just spoken about, which are all critical, or a developer or a builder or a consumer or whoever else it might be in that chain, how do we do that more proactively? And that's where latent defects comes in. That by getting involved in the front end, we can see and help manage a lot of those QA elements, because we've got a QA process throughout the build. One of the biggest elements of risk is time. Emily mentioned that earlier on. Time is a really key cost and element in that. We can help push that aside. When it comes to other pieces, it's a residual risk to a developer that financiers will be looking at. If you've got a strata bond, you've got that post-completion risk that is open. What is that exposure to a developer or builder post-completion? Most of the people in this room will be sitting there talking about, I've all been party to that legal dispute where I've got a folder full of defects, half of which are rubbish. Where do they come from? This is where latent defects comes in. It's a strict liability policy. It takes litigation off the table. One of the key elements of this for a developer and builder is that yes, it's great for the consumer at that end, but it also takes that item or that sleepless night, if you like, off the table for the builder and developer, because it removes that risk off their balance sheet back onto the insurer based on where the policy sits. So it's a dramatically more proactive approach. For the funder, they're always looking at elements that are sitting there to de-risk the project. That's what this does. Don't take my word for it. We've got different stuff that we work on with you, Mike, where funders are sitting there saying they will offer better rates if the risk is better. If they underwrite a risk and the risk is better, they will get better rates. They're in a competitive market as well. We've got that independently from funders at that point. This product brings about a position where you buy back marketing or bargaining power into your feasibility if you get involved in this thing early enough. You can upsell to purchasers, you can buy better rates from financiers, you can control projects much stronger during a project where you've got that QA element. Most builders and developers are doing a great job and all the rest of it. They're complex products. You've got a lot of widgets that are sitting there building into it. And what you need to be able to do is to have somebody on your side sitting there while the project's happening, de-risking that element.
You know, obviously when we've done surveys with clients, the main thing, and many of you guys have been to the events previously that we've run and we've shared some of the data, it's unequivocal the biggest thing might be outside of price in terms of people when they're assessing buying off the plan or buying or buying established property. It's around, is the developer actually going to deliver it and can I trust them? And so when we've done a lot of these types of surveys and asked people, how much would you pay to know that if something goes wrong, you're going to be able to recoup the funds? And the average piece, I think it was 80% of consumers said they'd pay between 2.5% and 5% incremental uplift in terms of the price just to know that they're going to be able to be covered. And obviously that's quite a lot less than what you guys charge. But, and again, for you, Matt, you know, people often forget the developers in this whole capital stack are the last ones usually get paid. You've got to pay all the funders on the way through. You've got your brand on the line in terms of things with the consumer. And when trust is low, not only the last one to get paid, but the first one to get blamed if something goes wrong, because everyone's going to blame the developer. So how do you assess the risk?
Well, I think for us, the risk starts right from the beginning of finding a site that you like, know you can develop, you can sell the product. Then when you're building the product, that you're going to build a good product, you're not going to be left with defects, that there is a strong quality control process going along. You've got partners that are there sharing in that risk with you, that have come on that journey, because there's both upside and downside to this. When we're talking to, I guess, the consumers, the market's shifted from a large off-the-plan market to people wanting to touch and feel the product. So then the risk then is, can you sell the product once you've built it? So have you met the market in terms of what you build? Back to the comments before around it's raising the game of the quality of those apartments, because you're not just selling it off the CGI, you are selling it off the touch and feel. You've got the livability built into there for the apartments that people want to live in for that particular stock, whether it be a 1 bed, 2 bed, 3 bed, 4, or whatever it is. And then it's about, I think one of the reasons why we as Abadeen took on some of the LDI insurance approaches was that it's a 10-year policy post-completion. So we as a developer are sitting there going, well, that's now dealt with post-completion. It's 10 years, consumer, the purchaser, they can be happy. They're not coming to us, they won't be ringing us every day to say there's a problem, they'll be going through the insurer, and that then protects our brand, that people feel like they've got someone to talk to, that things get fixed, and at the end of the day that comes back to repeat business.
I suppose with all of this in mind, there's been a ton of change within the market in terms of the type of people that are buying. So how do you see, or how much of it does it come into consideration when you're thinking if it's a first owner like type product or downsizer type product? How do you think about, the ebbs and flows of the different buyer demographics, and how do that help you assess risk?
That's a very good question with a very long answer. Through COVID, we saw the investors getting sucked out of the market, right? So that provided a real challenge, and so there was a pivot to owner-occupiers and downsizers because the detached housing market was going well. Now that's sort of slowed down, and so I think that there's certainly not a blanket across it from our perspective. It's very specific to the product and location, and equally the partner, right, in terms of do they have the existing buyer pool that they can tap into to try and break the back of those initial sales. I think because of the slowdown in the detached housing market, it's made owner-occupiers, there's a huge fight on for those owner-occupied buyers, right? We've got a lot of buyers in some of the products that we're invested in who are saying we love the product, we like apartment 404 or whatever it is, but we've got to sell a house. And they'll come back 6 months later, we still haven't sold our house. So I think that is making, there's a huge amount of complexity in getting the product right to attract the right buyers, and where those buyers are at in terms of their price point as well. I think affordability is a huge issue generally, but we're, as an example, we've delivered apartments into, just talking about a project that we have in suburban Brisbane, where we delivered apartments and sold out 120 apartments in 4 weeks at about $6,000 a metre. And we've got apartments in much more established blue ribbon locations that are still on the market at a much higher price point. So it's very nuanced, I think, and I think we're starting to see investors coming back. But someone was talking before about tapping into interstate markets, because interstate buyers are seeing value in Melbourne now, which we've seen that equally as well. So it's a tricky question to answer in one hit.
We had, I guess, told the story about 1,000 times, but bear with me, was that last year in April we had more people in Sydney looking at Queensland-based property than we had people in Queensland looking at Queensland-based property. And it's interesting how much that's kind of dropped off a cliff now, and when I say recently, over the last kind of 3 months, it was a massive uptick in terms of those Sydney buyers are now looking at Melbourne. And it's how quickly the transition happens is quite surprising where it'll go. It seems like they're almost talking to each other, where a huge group of them will just start all of a sudden looking at the different state, and certainly in in terms of the percentage of interstate buyers where they are looking, Melbourne is by far the most viewed interstate market, and it's now not even close. And 12 months ago it was the same extent, was 75% of interstate buyers were looking in Queensland, and it's something like that here in Melbourne now. And so how about for yourself, when you're kind of assessing these projects, because ultimately if you're getting in right at the start, Corey, you're relying on the project going ahead, and the project's often not going ahead unless people make the start. So how do you assess all that kind of stuff?
Yeah, well, they don't get paid unless they make a start. So at the end of the day, that's what we can look at is the feasibility. We've got to look at the project, who's involved, where they're at, is it likely to get going, and how does that work? So it's all a partnership point, but we're not looking at one point of just where is it and why is it. It's who's going to produce it and will it be there and what's the quality of it in 10 years. So rather than looking at that like from the point of view of, well, we know who it is and they've always produced good products, so we're assuming they will. We get involved and we work with the builder and the developer to make sure that it is built well. And that's not a point of standing over the builder or developer, because we have no control over that. It's to stand next to them and make sure that those elements that they may or may not miss are picked up during construction so that they can address them during construction. They're not a cost element post-OC when they're going to be 5-10 times the cost to address. Fix them then before you pay the bill, and it's a dramatic saving. Again, time saving and cost saving to build a developer is a significant point.
For you, what type of markets are you guys targeting? Obviously, each state is slightly different. I know you guys are pretty active everywhere, so what are you looking for?
I think the core market is the same across each of the states, which is the downsizer market. But I think the New South Wales shift to change some of the legislation to help medium rise is helping to open up some sites that weren't previously available. But I think that approach is the right approach. We're still in a massive housing undersupply here, and we need to sort of build more houses. But to the sort of point of getting those projects started, the shift post-COVID of the non-banks to sort of allow different financing structures and getting projects going with no pre-sales really sort of help that market, or the market generally, just move along. And I think now even the big fours are sort of moving their pre-sale requirements from sort of the 100% to 80% down to 40 or even less in some cases, because that's the only way these projects are going to get going.
It's obviously that's on the buyer side, but how about on the councils? Because obviously every council is kind of slightly different in terms of how difficult they are to deal with, and how do you think about location from a risk point of view as it relates to getting the project approved and getting the thing going?
Yeah, I think the risk is definitely there depending on where the project is. Every council is different. Every council has their own agenda. I think the biggest shift we saw sort of post-COVID and even now is that most things will take to court. It's a deemed refusal as soon as it goes, and take it to court and take it to an independent position, because the local councils have their own agendas and they're not helping.
Yeah.
As I say, the state stuff, legislation changes that have happened in New South Wales are providing a platform that sort of takes it out of the council's hands. And again, I think that's the only way we're going to get more housing built, is that there's a more strategic look at how we plan and master plan our cities.
We've been utilising some of those estate government pathways around the country. I think, particularly through COVID, post-COVID, where a lot of pressures come on the state governments to get more active in that space and release some of the red tape. So, the development and facilitation pathway DFB here. In Victoria, we've utilised to accelerate planning outcomes. Similarly, in Sydney, taking advantage of the LMR changes as well. Brisbane, the city of Brisbane is probably one of the easiest councils to work with, and also one of the largest councils to work with. So, we always have a pretty positive view on planning up there. But I think that particularly here in Victoria, the state government has at least done one thing right, which is introduced the DFB, albeit it's still pretty challenging, but we've utilised that pathway successfully.
And how about for you, Corey?
Yeah, I mean, if I look at where those things are moving, I think Pat made some great comments around regulatory change in New South Wales and what that's done. There's some uncertainty and some benefits that come from that. what we're seeing in Victoria is some of the change that's coming through, that's already happened and that's coming in the next month or so, is leading exactly on the same line as what New South Wales did. So while New South Wales got the transport orientated design, Victoria's got a very similar plan, which will open up a whole heap of land and enable the government to get in and make that process quicker is a critical piece.
Just want to say thanks to all three of you guys for coming up and sharing your insights. It's really helpful. Good stuff.